Brokers Digest, a webcast series by The Edge Singapore, discovering market opportunities with you. This episode is sponsored by Phillip Futures.
Hello and welcome to The Edge Singapore's Brokers Digest with me, Amala Balakrishna. We are back with a brand new series in which we will be discussing stock market movements as well as counters to keep a watch on. There has been quite a lot of movement in the US market in the past 2 weeks, starting with optimism following the confirmation of President Biden's $1.9 trillion economic rescue package. This positive streak extended when the Federal Reserve maintained near zero interest rates, at least through to 2023. However, things took a turn on Friday, 19th March, when the Fed had declined to extend a rule expiring at the end of the month that relaxed the supplementary leverage ratio for banks during the pandemic. So the 30-stock Dow Jones Index was down 0.5% for the week ended Friday, 19th March, while the S&P 500 lost 0.8%, and these two indices were breaking their 2-week winning streak. So similarly, the tech-heavy Nasdaq inched down by 0.8%, making this its fourth week-on-week decline. So joining me today to talk about these movements is Maurice Chiu, an analyst with Phillip Futures. Hi, Maurice. Welcome to the show.
Hello.
Hi. So, Maurice, why do you reckon the markets have been so sensitive to the announcements?
Well, Amala, I think that for the past year at least, what we are looking at is people are struggling to make sense of easy monetary policy. It's an era of unlimited QE. And just recently, I think it's very famous economist, chief economist, director of Obama administration's Economic Council, Larry Summers, he described the recent slate of stimulus packages as least responsible fiscal policy in the last 40 years. So that's quite some damning criticism, and I could explain a bit of the turmoil.
So one thing that stood out for me last week was how bank stocks sold off in unison after the Fed's decision not to extend the rule. And this saw counters like JP Morgan and Goldman Sachs sliding by over 1%. So Maurice, is this the time for our viewers to scoop up the stocks of banks or other blue chip counters?
I mean, taken as a whole, 1% isn't really that much of a move given how much they've rallied since November. You're talking about double-digit rally. So I think, yes, it's good to perhaps think about, as part of a portfolio. But there is some evidence to show that maybe financial stocks aren't really the best thing, which probably we'll talk about later on as well.
So just now you said that, whether it's a lot or you kind of indicated a bit about the quantity and the value of the stocks. So one thing that I have been hearing quite a bit is that US stocks are overvalued. So is this really the case? And is there a way for our viewers to ascertain this?
Right. So I think the slide that we're looking at now is one thing I'll point out is that PE ratios over the years, they've been drifting upwards. And I use the word drifting kind of lightly because you can't really conclusively say that PE ratios will stay at this level forever. But what's very notable to me is that, you're looking at in the 10s at the left side of the chart, then in the 20s, but right now at the beginning of 2020 to 2021, you're looking at PE ratios that are 30. So I'm not really suggesting anything that, this is going to be a level that's going to go back down to 20. I'm not suggesting that at all. But what I'm saying is that, there has to be a discussion where people think about, is this a fair price to pay for the stock when I'm paying it something like 30 times its earnings per share? And this goes some way to explaining whether you are paying are stocks overvalued right now?
Right. So to our viewers, PE ratio is defined as the price you pay per dollar of earnings for a particular stock. So Maurice, a question that a viewer had was, which sectors are overpriced and which are the laggards that you notice?
Right. So I think the really high price sectors for the longest time, even pre-COVID, has always been tech. So if you look at NASDAQ as a proxy of tech stocks in general, the NASDAQ PE ratios have always trended higher than the S&P and the Dow Jones. But of course, for the NASDAQ, one thing that is notable is that the range of PE ratios is very high. For instance, if I talk about Tesla, just in terms of their PE ratio, just these few days, their forward PE ratio is at 150. Whereas for S&P, you're talking about 25, 30. So the interesting thing to me for that individual counter, right, is that people are having this discussion, are tech stocks in general overpriced? Then in comes Tesla with 150 P forward P ratio, and people are saying that it's cheap at $500. So I think they really need to take take a step back and see that firstly, tech stocks usually have a higher valuation. But then of course, the next thing they need to look at is justifying that valuation, which I think we can probably talk about later. So for this chart here, what you're looking at is that, rather the point I want to make here, if you like, is that, tech stocks really started outperforming only not that long ago. For instance, consumer discretionary, which is the purple line, the second best performing one, right? It actually was the top performing one until tech stocks overtook it somewhere in 2019. So it's kind of like what you got to do is a bit of a mindset shift where this could be the start of a new era where tech stocks do pull ahead of the rest of the pack and they do even better in the future. And I think there is evidence, or rather there are arguments on both sides why I think they'll do better in the longer term and why, this is a bit of hype and maybe it wouldn't do so well in the longer term.
So what are these arguments, Morris? Maybe you could just take us through them.
Yeah. So there's this concept of like a do anything kind of achieve everything kind of conglomerate, which you probably wouldn't have seen, say, 20 years ago or 30 years ago. And what do I mean? Just to focus the example, right? I give one, which is Amazon, for instance. So what did Amazon start out as? Everybody knows Amazon started out as, selling books. But what do they do now? And what kind of news is coming out of Amazon? So to me, what was surprising about Amazon itself was that, Amazon is classified as a tech stock. A component of their business that grew a lot in the last year or so is actually digital advertising. And it's forecast to grow like 3 times just their digital advertising unit in the next 5 years, which is, to me, is like, wow. And at the beginning of the year, they started doing things in other sectors, which is logistics. They started buying their own planes. In 2020, they expanded their warehouse floor space by 50%, where, in general, people were kind of thinking like, how do I downsize my business? I don't need that much space. But in comes Amazon, so they're doing a lot of things. And what they're more famous nowadays is for Amazon Web Services. So the point I'm trying to make here is that you are seeing these kind of companies which are doing everything. And what's really enabling this, right, other than, deep pockets, is that they also have a lot of expertise and they have a lot of data they can rely on, both consumer data, supply chain data, all sorts of data that they can really scale their business. So back to the point of prices, right? A company like Amazon will find it easier to kind of attract people to its shares. Why? Because markets are forward looking. I look at Amazon, I look at their so-called, my words, plans for global domination in terms of every sector, and I think that the price is justifiable. On the other hand, Amazon hasn't done a stock split since 1999. So, the stock price is very, very high. And what's the thing dominating headlines nowadays? You're talking about retail traders by volume. You're talking about Robinhood, you're talking about GameStop, things like this, right? So these Amazon stock price is now in excess of $3,000, and I can tell most retail traders don't really have that kind of, rather they would go for other kinds of stocks. So there's a huge kind of artificial ceiling, if you like, on the price potential for, say, a stock like Amazon, in my opinion at least, because of something like that, among other things. Yeah. So to me, those are for and against, for instance.
Yeah, I noticed actually, Morris, that Amazon has been one of the top counters in the tech and growth stocks category that our viewers have been looking at. So just now you mentioned the pros and cons of the counter. Do you have any other counters that maybe you could think that our viewers should continue to look at in the weeks ahead? Some of the other counters that I noticed that have been quite popular have been Fastly and Netflix and even Apple. I presume it's because now with most people working from home, these services have become a lot more like companions in the past few months and even the past year.
So maybe talking about a couple of companies. So I'll start with a brief point on Apple itself, right? So Apple to me has been a bit of, in just my opinion, so not saying it's good or bad or anything like that, but it's been a bit of a head scratcher in terms of its stock price. So they're kind of a do no wrong kind of company because they have had a lot of very good, how you say, they've had good leadership that kind of minimize disruptions to their business during the pandemic. They've done well during the pandemic. They're releasing new products all the time. Their company morale is good, which is actually quite going to be an increasing factor in my view when you're seeing things like Google and Amazon. Your workers are unionizing. Apple doesn't have those kind of issues. So they're kind of doing the wrong stock, and they can do things like they release a new product line and then the share price goes down. So for investors, right, they have to do more than just look at, say, positive news and then they think like, okay, I think it's a good buy, it's time to go in. Because in comes this consideration that people have probably already priced in the potential for Apple many months ago. So what you're seeing now is really profit taking when the news comes out. So their fair price could probably be a lot lower. So people have to get used to this concept that in the past year, when the world was flush with cash, you talk about QE, skyrocketing savings rates, that most of this positive news has already been priced in. It does not mean that because a company is doing well, the share price will go higher. And I think that really kind of half answers the question, are stocks overvalued? I think there's a strong case to say that for tech stocks, they are. So that's that for Apple. And maybe I'll talk about another one which wasn't particularly mentioned yet, but I think a lot of people are either interested in or have exposure to, which is Tesla. So to me, the interesting thing about Tesla is the firstly, short sellers have been losing a lot of money on Tesla over the years. So it's always a bit of a there's a bit of a quantitative kind of analysis issue. Should you take a long view on Tesla? And also there's a kind of like a personality. How you say?
Elon Musk has been the man of the
Yeah.
year, I think. Yeah.
Exactly. Because he's forward-looking and markets are forward-looking as well. And they kind of believe, they buy into his vision. Perfectly fine. Because I mean, that's what markets are about. It's about sentiment, right? But I mean, there's an increasing body of evidence for certain units of their business. Because I mean, their business is so wide. They're doing so many things. How do you keep track of that? I just focus your attention on one, which is China, for instance, right? So rather the fastest growing electric vehicle kind of market in the world is in China. And Elon Musk has accordingly sunk his roots into China in terms of Tesla, at least. And it's a big kind of, it's a big stake for them. And in terms of their future projections for growth, for production, things like that. So, and I say that, investors should be aware that they should, or at least they should monitor the progress of Tesla in China. Because firstly, there's a lot of competitors. And secondly, Chinese equities, or rather, companies operating in China, there's increasing body of evidence to show that, their fortunes rise and fall. And it's less to do, or rather, it has something to do with the company fundamentals, but it also has a lot to do with what regulators are doing. For example, for our viewers, at least, who have been monitoring the Chinese stock market, it's been quite rocky. So, and a lot of that has to do with what regulators have been doing, which is they're trying to kind of ease what they see as asset bubbles as well. And they're also kind of like trying to crack down on tech giants. So Tesla has to be very aware of this, of certain possibilities. In just my opinion, it hasn't happened, but there's this sense that the government or the people would perhaps support a local brand over Tesla. And then they can't have those kind of skyrocketing, very nice exponential growth in terms of vehicle sales in China. And second is, there are kind of beyond economic risks for Tesla in China. And so back to the point I'm making, they have a bit too much skin in the game in terms of that unit. And I think investors have priced a very rosy picture for that, for Tesla in China. Yeah. So that's my view on it. So quite risky in my view. Not ruling out for the upside. Then again, downside is also possible.
Yeah, Maurice. I think, like you mentioned, Tesla has been one of the it counters for the year, especially since Elon Musk became very famous, and there's been so much of interest in what he has been doing with the company. So to sum up our discussion on tech stocks and growth stocks, you see, like you said, there's a lot of positive sentiment around these sectors. And one of our viewers actually asked whether you think that their good run thus far is going to continue in the months ahead. So if you can just like gaze into the crystal ball and tell us whether you think that this is going to extend.
I think one way of looking at it is near term and long term, just to temper expectations. So near term, I think there's a bit of a consensus around the world, but also consensus doesn't mean it's definite 100% prediction of the future, but there's a consensus around the world, and it's good for investors to take note of that. There's an ongoing rotation into cyclicals that has maybe another double-digit percentage kind of potential. So what am I talking about? If you're an investor tuning in, you just can observe any potential divergence between the Dow Jones and the Nasdaq in the coming days, and that kind of paints you a nice brief picture of performance of tech stocks versus cyclicals in the near term. Cyclicals being stocks that do well when the economy does well. Okay, so that's in the near term. But longer term, I think people have to ask, right, that firstly, are tech companies going to be able to justify their price in terms of earnings? Okay, so that goes down to what they've been doing during the pandemic. So right now, we're talking about easy monetary conditions. Okay, one way of looking at it. Easy monetary conditions, you're getting low borrowing rates. Okay, so low borrowing rates, it's the bedrock of capitalism, so to say. So or rather, borrowing is the bedrock of capitalism. So what you can do with the money, or rather, what have you been doing with that money? Have you been spending it on machinery, acquisitions, property, all sorts of things that will generate returns in the future? Or have you been doing it like giving yourself compensation and giving holidays, breaks, things like that? So, I think that's something that investors can look at, whether a company has been responsible with, or rather they've been taking advantage of low rates, because low rates will not last forever. What we are seeing with rising bond yields recently, right? And in this chart, you can see it's a black line, is that bond yields right now, they're at 1.7%. And they've been trending before the pandemic at around 2%. So it still has further to go. And what they really reflect is that there's expectations in the future for rate increases and for inflation expectations. So my point here, if I were to just say in one sentence, is if a company isn't doing like wise things with this low borrowing costs right now, I don't think they're going to survive that well when borrowing costs increase. Yeah.
Yeah. So actually, Maurice, just based on what you said, I'm reminded of another question that a viewer had, which is if stocks in the financial sector were overbought, and this viewer also thinks that the US Treasury yields are oversold. So what are your comments on this?
So perhaps I start with Treasury yields, right? Treasury yields oversold. I'm assuming the viewer didn't mention, or rather didn't come from a place where he's using, say, indicators from technical analysis kind of standpoint. So with that base in mind, they've been going like this, right? Treasury yields, they're going low base since last March, and then they've been going really, really high. And I think it's quite, quite straightforward that, you weigh the likelihood. Pre-pandemic, it was around 2%. Right now, it's at 1.7. So now people are talking about, US household incomes are above pre-pandemic. Your projections for economic growth are going to be really high, which is like 6%. So there's no reason to really believe right now that the US economy isn't going to recover to pre-pandemic levels. Therefore, it is very likely that yields will go to 2%. At least that's how I'm reading this. So that's it for yields. And, I think maybe you're going to see it hit near 2% before some meaningful correction takes place. Or maybe someone feels the pressure, like say the Federal Reserve feel the pressure to do anything. I don't think that's likely, because he's made it abundantly clear. And the other thing you asked, or rather the viewer asked, was about financial stocks. Is that right? So financial stocks itself, I think one thing interesting is that, what is it when you're investing in a stock? You're investing in a company itself, not really the sector. Debatable. But what's happening here is that you're talking about the profitability of the company, right? So why have they been rising recently? Because people are expecting, firstly, cyclical rotation. So that's one component of their growth. Secondly, is bond yields rising, which is supposedly supposed to increase their profitability. But the thing about that is that bond yields, right? When people say bond yields in the news, they're talking about 10-year yield. But what's more relevant to profitability of most of the time for banks is that it's actually the short-term yield. So the short-term yield is actually like that. So it's actually trending downwards, and that's going to impact their bottom line. So when people are, investing based on the 10-year yield, well, all I'm saying is it's not that relevant. So I just have a feeling that, the crystal ball thing, right? Just have a feeling that they may be in for a surprise when it comes to around the earnings season. But that's just my view. So I would say a bit overdone. Not so overdone for treasuries, but a bit overdone for financials.
So actually, just based on that, before we end today's discussion, I just have $1 million question for you. You said that, viewers may be in for a surprise if that's how they're going to be trading. So do you have any tips on what they can be doing or what they can look out for in the next few weeks?
I think that, really is $1 million question. Is it now we're here and it's really quite high? So is it going to go even higher or is going even lower? If I had a piece of advice for most people, because in the end, what's it usually about? It's about, building your wealth. Nobody's in this to lose money in a sense. I would advise people to look at things like correlation. Okay. And take note that in the past few decades, correlation between industry sectors, at least according to S&P research, has shown that correlation between different industry sectors has been increasing, again, drifting upwards. So what you're saying is that, hey, I don't really want tech stocks, therefore I'll diversify by going to something else. And all I'm saying is that 5 years from now, it's going to be increasingly correlated because it's a long-term trend. So what you need to perhaps consider, or what I would submit for people to consider, if you like, is look at things like correlation by diversifying in terms of geography, in terms of maybe into things like commodities, into anything but equities. Start looking at something else instead, and you don't have to go into something like that, but monitor the progress because it's still an ongoing kind of discussion. It's a point of debate for most people. So take note of the correlation of your portfolio, I would say.
Yeah, I think that's great advice, Maurice. And I think as we go further, we notice that increasingly sectors are becoming more and more correlated. So with that, we have come to the end of this week's Brokers Digest. Thank you again, Maurice, for sharing your insights and tips on counters to keep a watch on. To our viewers, we hope these strategies have helped you in your investment decisions in the short and medium term. For more analysis on the stock market, you can visit the websites of Phillip Futures or The Edge Singapore. Do like us on Facebook and Instagram to be alerted on our next episode. We will be having an insightful session jam-packed with more trade secrets on tech stocks, which I'm sure you won't want to miss. You can also leave us a comment below if there are any questions or topics you would like for us to discuss. I'm Amala Balakrishna. With me is Maurice Chew, and we'll see you again in 2 weeks. Take care. Goodbye.